Hey, what's up? Coach B here. Another episode of Chalk Talks. Today we're finishing up the conversation on option Greeks, and we're finishing off with VEGA. If you're just finding the channel and want to catch up, check out the options basics playlist I've been working on for a while now. And in future videos after this one, I'll start talking option strategies for both bullish and bearish plays. First thing you should know about VEGA is, just like theta, it has no effect on the intrinsic value of an options price. It only affects the extrinsic value, the time premium, okay? Basically, VEGA's controlled by IV. We talked about implied volatility in a previous video, but as IV rises, VEGA will increase your options price. And as IV decreases, VEGA will decrease your contract price. So, just as an example, if we're looking at, let's say a $10 stock and the $10 strike, and that's selling for, let's say, $1 a contract. Okay. So stock's at 10, strike price 10, contract right now is $1. IV on this is currently at 80%, and VEGA is 0.05, so 5 cents. If IV increases to 81%, so 1% move in IV, doesn't matter if the stock moves in price or not. It's still trading at $10. I can assume that my contract will now be worth $1.05. $1 was my initial contract price plus a 5-cent increase because of the 1% rise in IV. So, same exact scenario. 5 cents VEGA, but this time let's say IV jumps from 80% to 90%. That's a 10% jump. So again, stock doesn't move in price. The stock's still trading at $10, but we can expect my contract to increase by 50 cents, right? 5 cents times 10 because of the 10% increase in IV. So now my contract's going to be worth $1.50 because of the rise in implied volatility. This also works in the reverse. So if the stock were to remain the same and all of a sudden IV dropped to 70%, that's a 10% loss now. I can expect my contract to lose 50 cents in value, making it only worth 50 cents now. Now, obviously, just like the other Greeks, these numbers also fluctuate, right? So because it only affects time premium, VEGA is going to be higher with further out options than it is with nearer term options. And the closer we get to zero in a contract's price, VEGA will start to decrease because the contract can end up being free. It's always got to hold some value if there's time left, or at least be worth a penny. Another thing to note is that the closer to, at the money we are, the higher value VEGA tends to have. And as we get deeper in the money or deeper out of the money, VEGA is going to decrease in value. So let's take a look at the option chain to see some real life examples. Okay, we're going to start with DraftKings, ticker symbol DKNG. This is a play I've been following for some time, but the IV is relatively low. It's sitting at, about 54% down here, 53.49%. So if we look at the contract that, let's say, is a month out, maybe September 24th, and let's just go in here and see at the money. Okay, so right here, at the money on September 24th, contract's going for $2.84. VEGA is 0.07. So again, sitting at 53% IV. If all of a sudden IV was to jump up to 54%, we can assume stock doesn't move. We can assume that, the contract's going to go up 7 cents to $2.91. If it goes up 2%, let's say to 55%, we can assume that the contract is going to go up 14 cents, 0.07 times 2, which would put it at about 2.98. Okay, so that's how it works. But now, so that's at the money. VEGA's 0.07. If we look further in the money, we could see that it starts to decrease, 0.06, 0.05 at the 55 strike, 0.03 at the 51 strike. DraftKings is currently trading right around $60. And as we go further out of the money to 90, 0.01. Now let's move down to some other, dates. All right, so we were looking at a contract that was basically a month out, September 24th. Let's jump ahead to 6 months out. Let's say February 18th. Okay, and basically now at the money we're trading at $7.20. VEGA's now 17 cents. Again, there's more time on the contract, so it's going to be a little bit higher because this affects time premium. So now, if all of a sudden DraftKings was to jump up 1% in IV, 2% in IV, we can expect it to continue to increase by 17 cents, which is actually, not bad for an options contract. So, we move up 1%, we go to 737. Move up another percent, we go to, what would that be, 754? I believe. I hope that math's right. But yeah. And then if we look in the money, it starts to decrease, as we go deeper and deeper. Eventually it gets to zero where Vega has no effect. And that's the same thing when we go further out of the money, but it's still holding a value of about 12. So even this contract out here going for 258 would still increase by 12 cents with every spike in IV, every 1% spike. So finally, let's look at some leaps. Okay. Some longer term, January 23, and at the money strikes, we're looking at 1365 with a Vega of 0.28 now. So now we're going to move up 28 cents every time IV goes up, or decrease 28 cents in contract price every time IV decreases. So as you can see, the further out you go, the more Vega has an impact. Okay, so DraftKings has relatively low IV. And luckily today, we had some insane movements in other stocks, and we've been having some movements in some other stocks, which gives us an opportunity to look at some other examples. Let's take a look at AMC first. Popular play amongst retail. I'd imagine IV is going to be much higher than DraftKings is right now. And it's kind of similar in price. It's actually a lot lower. DraftKings was trading at 60. AMC's trading at $40.84. If we look at the IV right now, looks like IV somewhere around 162. Okay, so much higher, almost 3 times the amount in IV. So let's see what an at-the-money contract is compared to DraftKings, which is actually, like I said, trading for higher. So if we go to September 24th, at-the-money contract, $6.80. IV about 0.04. Let's jump out a little bit more to February. There's no February here, so I'll just look at January. Looks like at the money is $14.30, 0.09 Vega. And finally, the leaps here. At the money, 2305, 0.15 Vega. So why are we paying more than double for at the money premiums on a stock that's trading for $20 less? Vega, right? So, if we look, let's just look at these again. Just at the leaps. $23 a contract for a stock that's trading at $40. And then with DraftKings, right at the money, $13 a contract for a stock that's actually trading higher at 60. Again, Vega, implied volatility makes a big difference. Okay, so my last example, and this is where I said today we had some huge days in the market. Before we wrap up, is going to be SPRT. Had a huge day, so I'd imagine IV is through the roof. It gained about 33%, I think, on the day. Yeah, 33% on the day. It's trading for 26.33 right now. But at one point, I believe it was up over 100% today. And if we look, IV's actually at 364. So, that's even more than double the high IV of AMC. So let's look at the at the money options for these. So at the money on September 17th, ridiculously high IV, $9 a contract for a stock that's trading, almost half the price of AMC, and 0.03 IV. And then we don't have anything in February and January. So let's just look at December, which is actually even shorter term. So we'd expect the contract to be cheaper, but $15.20, 0.06 IV. Okay. Or not IV, but Vega. Sorry. 0.06 Vega. Again, much lower stock price, and yet we're paying more for at the money options. Why? Vega. There's no leap. So that pretty much wraps that up. And, consider this. AMC IV right now is 160%. And Vega a month out is basically about 0.04. So if you owned an AMC contract today and all of a sudden it spiked to the SPRT levels, IV of 360%, That increase would equate to almost $8 more in time premium. That's $800 per contract just based off the IV increase of 200%. On the flip side, if the IV on SPRT was to decrease down to AMC levels and drop 200%, you're going to lose $8 per contract overnight. This is why it's very important to pay attention to IV. Buying contracts on stocks with insanely high IV can really bite you if the stock starts trading sideways and IV decreases. Even if the stock price doesn't move, you can lose a ton. This is another reason traders often warn about holding contracts through earnings. A lot of times when a company reports earnings, we see a huge increase or decrease in IV, a drop, as traders are showing their contracts leading into the earnings or right after the earnings. And even if the stock has decent earnings report, IV crush can kill your contracts. Again, just another thing to look out for when trading options. My rule of thumb has always been this: buy shares when IV is high, to avoid that IV crush. And basically, there's no expiration date. You don't care if it's trading sideways. You're not going to get killed if all of a sudden IV decreases. So IV's high, buy shares. And on the flip side, buy options when the IV is low. You could do that. You could potentially capitalize on IV spikes and, everything else, movement in the stock, everything else we've talked about. Anyways, hope you enjoyed the video. I hope that makes sense on what VEGA is. Hopefully you've watched the other ones. You got a good idea for what the Greeks are. That wraps up this Greek series. And in my next options video, I'm going to start covering strategies. We'll start off with some basic strategies, lead into some more advanced ones, and hopefully start learning how to implement these things to make some money. As always, if you have ideas for future videos or questions about current ones, don't hesitate to leave a comment. Also, if you're enjoying the content, please hit the like and subscribe button. It helps the channel out a lot. And don't forget to check me out every day the market's open, live streaming during pre-market on Talking Stocks with Coach B. Have a great day.